Welcome to the deep dive. You've handed us a dense stack of source material on Eaton Corporation pleat ticker ETN, and our mission today is, well, it's pretty complex.
It is.
We aren't here for just a simple company review. We are going to run a critical stress test on what we might call the industrial perfection thesis.
And that's really the core challenge for you, the discerning shareholder. Eaton has become the darling of the electrification supercycle.
Absolutely.
The market narrative believes it is an infallible compounder. Our job is to move past that excitement, past the hype, and ask a very difficult question.
Which is?
Is the price, and we're talking to 30 times forward earnings multiple, is that price already discounting a perfect operational and growth future? Because if it is, you're left with absolutely zero margin of safety.
Exactly. The critical investor needs to move past the marketing hype, this idea that Eaton is the indispensable arms dealer for AI data centers, and get down to the quantitative evidence.
Right.
We've synthesized a lot here. Comprehensive investment research, the latest Q3 2025 reports, and some really detailed competitive analysis. The goal is to separate the structural quality of the business from the qualitative risks that are embedded in what is a historically unprecedented valuation.
And we have to anchor this entire deep dive in that one immediate contradiction.
Yeah.
Eaton is trading as if it were a high-flying sauce company. It's capitalizing peak cyclical earnings, I mean the highest margins and the best demand environment they may see for a decade at a secular growth multiple. This sets the stage for our entire discussion today. We are analyzing a good business at a bad price.
Good business, bad price.
And if you agree with that premise, well, the rest of the analysis is really about justifying that bad price risk.
Okay, let's unpack this business model then. I mean, you have to admit, Eaton has executed a genuinely masterful strategic pivot.
Oh, undeniable.
They shed the cyclical, the capital-intensive baggage of their past life as an automotive supplier, and they've emerged as a premier power management firm. On paper, they look perfectly positioned.
They look like the quintessential beneficiary
Of every major multi-decade secular trend, right?
Right.
Re-electrification of infrastructure, North American reindustrialization, and of course, the massive surging power demand from AI.
The transformation is undeniable. However, for the purposes of valuation, and this is critical, we cannot treat Eaton as a monolith.
No.
The sources all highlight that Eaton operates as a two-speed conglomerate, and understanding this internal bifurcation is, well, it's absolutely paramount. If you assign the same growth multiple to every single dollar of revenue, you will overvalue the lower quality parts of the business, period.
And the runaway winner, the segment that's driving this entire valuation, is clearly Electrical Americas.
Without a doubt, this is the crown jewel, the hegemon, as some of the research calls it. It accounts for a substantial 46% of total corporate revenue. But, and this is the important part, it contributes a disproportionately higher share of the operating profit. This is the engine that earns that premium multiple.
And the numbers are they're staggering.
They are. In the third quarter of 2025, this segment delivered a simply staggering 30.3% operating margin.
30.3%.
That figure is not just great for an industrial company. It is argued by analysts to be, best in class for the entire industrial manufacturing sector globally.
30% margins for products that are essentially copper, steel, and plastics. We're talking circuit breakers, switchgear, panel boards. That's not a margin profile. That's a structural pricing advantage. What exactly is the structural moat that allows them to extract that level of profit?
So the moat is it's regulatory, it's geographic, and it's deeply ingrained in decades of industrial policy. The North American market is governed by NEMA.
The National Electrical Manufacturers Association standards.
Exactly. And this set of safety and performance standards diverges significantly from the IEC standards that are used in, well, the rest of the world. Crucially, these NEMA standards are integrated directly into North American building and fire codes.
So it's not just a preference for engineers, it's a mandate.
It's absolutely a mandate. It functions as a massive natural regulatory barrier to entry. Foreign competitors, especially those from Asia or Europe who are focused on the IET standard, they face an enormous, costly, and multi-year certification and localization hurdle just to gain broad acceptance in the U.S. market.
So this divergence creates a protected market.
A protected, consolidated market structure. It's an oligopoly, really, shared with a handful of others. And in that environment, Eaton enjoys immense pricing power and much less threat of competitive erosion. This is the very definition of a regulatory toll booth.
I appreciate that clarification. It really reframes that 30.3% margin. It's less about some kind of unique technological supremacy and much more about a geographically protected market.
That's the key.
And that phenomenal profitability is backed by incredible demand visibility, right? The backlog numbers are huge.
That visibility is a key supporting factor for the high valuation. The Electrical Americas backlog swelled to an incredible $12 billion in Q3 2025.
$12 billion.
That's a 20% increase year over year. For experienced analysts, that kind of visibility is worth gold, and we can see exactly where that demand is coming from.
Data centers.
A 70% surge in data center orders. This validates the market narrative completely. Eaton is indeed the primary beneficiary of the AI build-out and the reindustrialization trend here in North America. This $12 billion provides high-quality revenue conversion visibility that stretches well into late 2026 and across 2027.
Okay, so that's the Speed 1 business, the near-perfect 30+% margin hegemon. But now we have turned to the Speed 2 business, Electrical Global. How different are those economics?
We're radically different. I mean, night and day. Electrical Global covers Europe, the Middle East, Africa, and Asia Pacific. It accounts for about 25% of revenue. In this segment, the competitive dynamics are brutally global.
So no Neiman protection?
None at all. This market uses IEC standards, which means it's far more fragmented, less regulated, and just fiercely contested. Here, Eaton is fighting massive, fully globalized industrial giants like Schneider Electric, Siemens, and ABB.
And local players, too.
Plus hundreds of aggressive, low-cost local competitors, particularly in Asia. It's a knife fight.
And the margin spread is the irrefutable evidence of the lack of that geographic moat.
Precisely. The numbers don't lie. Margins in the global segment typically hover around 19.1%, as they did in Q3 2025.
19 versus 30.
That 1,000-plus basis point margin spread between the Americas and the global segment is the single most important data point for you as a critical investor. It tells you unequivocally that the bulk of Eaton's premium valuation is purely a function of its geographic and regulatory protection in North America.
Not some unique global technology that commands pricing power everywhere.
Not at all.
That makes the portfolio inherently impure. But the impurity doesn't stop there, does it? We have to address the structural flaw, the remnants of that cyclical past. The mobility group. This is the hidden value discount, isn't it?
It absolutely is. It's the portfolio impurity that sophisticated investors just despise. It's the portion of the company that is structurally shrinking and actively dragging down the consolidated multiple.
So break that down. What's in the mobility group?
It's comprised of vehicle and e-mobility. The vehicle segment, about 11% of revenue, well, it's exactly what you'd expect. It's cyclical, it's capital intensive, and frankly, it's irrelevant to the secular growth story everyone's excited about. It posted a painful 9% organic revenue decline in Q3 2025.
A 9% decline while the rest of the business is booming. And what about e-mobility? This was supposed to be the future, right? The bold bet on the EV transition, capturing that high growth phase. Why is it failing?
The e-mobility segment, at a mere 3% of revenue, is the bigger strategic failure. It has utterly failed to scale profitably.
How bad is it?
It consistently posts operating losses. A $9 million loss just in Q3 2025. And it suffered a severe 20% organic revenue decline.
20%?
A 20% contraction. This signals a deep structural problem. Was it bad market timing? Were their offerings technically inferior to competitors like BorgWarner? Whatever the root cause is, its persistent underperformance forces a really crucial question.
The question analysts have been asking for years now.
Exactly. Why is management clinging to these chronically underperforming cyclical assets?
It speaks to a fundamental tension in their strategic direction, doesn't it?
It really does. Divesting the entire mobility group would instantly purify the portfolio, it would elevate the consolidated margin substantially, and it would allow the market to apply a cleaner, higher multiple much closer to a pure-play electrical peer.
So why not do it?
The fact that management has resisted this strategic simplification, even while making these massive electrical acquisitions, suggests either an unwillingness to admit a venture failure, especially in the case of e-mobility, or some misguided belief that these segments still offer synergy or some hidden value.
And for you, as the shareholder?
For the discerning shareholder, the continued tethering to these shrinking, unprofitable divisions is a significant strategic drag. It is actively masking the true quality of the core Electrical Americas business.
It also adds a layer of complexity right when they need flawless execution on their biggest bet ever. And we'll definitely return to the strategic implications of that management tension later when we discuss the Boyd acquisition and the CEO transition.
The qualitative story of the moat is strong, but for the experienced investor, the moat has to be quantified. You need to see it in the economic returns.
Yeah.
We need to confirm that Eaton is consistently creating genuine economic value. And the way to do that is by ensuring their return on invested capital, their ROIC, significantly exceeds their weighted average cost of capital, or WACC.
Okay, so let's look past the press releases and confirm the quantitative proof. What do the cold, hard numbers tell us about their efficiency in creating value?
The sources confirm value creation is happening, but it's not, limitless. Eaton's current trailing 12-month ROIC is approximately 14.0%.
14%. And the cost of capital?
When we estimate their WACC, which is the minimum return required to satisfy all capital providers, it sits around 9.15%. So that calculation results in a healthy positive economic spread of nearly 485 basis points.
And that spread is the proof.
That economic spread is the mathematical confirmation that Eaton is indeed creating genuine shareholder value above the cost of their financing.
A 485 basis point spread is respectable. It definitely confirms the strategic pivot worked. But when you compare that 14.0% ROIC to the true industrial elite, how does it hold up?
This is where the impurity of the portfolio becomes really evident in the financial metrics.
The drag from mobility.
Exactly. While the return on equity, the ROE, is robust at roughly 21%, the consolidated ROIC of 14.0% is solid, but it prevents the company from being classified among the wide moat leaders of the sector.
Who would be in that category?
Well, you look at peers like Illinois Toolworks, ITW, or Rockwell Automation, they often boast ROE figures well north of 30%, and they sustain that over years. The drag on Eaton's number is traceable directly back to the vehicle assets, which are very capital intensive and deliver much lower returns.
So this calculation really solidifies the idea that while the Electrical Americas segment might have a wide moat, the consolidated company, because of these impurities, is best classified as having a narrow moat.
That's a perfect summary.
So the lower quality segments aren't just a drag on the growth narrative. They fundamentally prevent the entire company from achieving the financial efficiency metrics of a true pure-play compounder. That's a critical distinction. Now, let's pivot back to the qualitative sources of that moat's durability. The sources identified 3 key non-financial advantages.
The first one is built on the fear of failure. We're talking about switching costs and mission criticality. In core infrastructure, it doesn't matter if it's a utility grid, a hospital, or a hyperscale data center. Power components are inherently mission critical. A $50,000 piece of equipment failing can lead to multi-million-dollar liabilities, data loss, or even risks to human life.
The cost of failure is catastrophically asymmetric to the cost of the component itself.
Precisely. And this makes customers extremely risk-averse. And crucially, it makes them highly price-insensitive regarding these core power components. They demand certified systems, proven reliability, brand loyalty. Once Eaton switchgear or transformer is specified into a design and installed, the switching cost is just astronomical.
And that incumbency creates recurring revenue.
It leads to sticky, recurring revenue streams from maintenance, software updates, and replacement parts, which reinforces the moat for decades to come.
Okay, the second advantage is one that often flies under the radar for investors focused only on technology. The distribution network dominance, what the sources call the channel moat.
And this is a massive, almost impenetrable operational barrier in North America. The demand side of the electrical market consists of tens of thousands of local electrical contractors, electricians, small and medium businesses. They need immediate product availability, just-in-time logistics, and complex services.
And Eaton's relationship with the big distributors is key.
Their multi-decade, deeply entrenched relationship with major North American distributors, we're talking Wesco, Graybar, and others, is an immense asset.
But why can't a well-funded foreign competitor just build a similar relationship? What makes that channel so sticky?
It's not just a handshake deal, it's a whole ecosystem. The distributors rely on Eaton not just for the product, but for training, for proprietary sizing software, for complex credit and financing terms for their contractors, and for logistics integration that took literally decades to perfect.
So a cheaper product isn't enough to break in.
A Chinese manufacturer might offer a product that is 20% cheaper. But if the local contractor's preferred distributor, let's say Wesco, doesn't stock it, doesn't certify it, or doesn't offer the same credit terms, that competitor simply cannot reach the fragmented U.S. demand base. This channel dominance protects Eaton directly from low-cost competition that lacks U.S. market access or, just as importantly, channel trust.
That makes the barrier far more formidable than just a simple regulatory standard. Finally, let's look at the emerging forward-looking moat, technological integration, which is centered around the Boyd acquisition.
Right, this is the strategic vision that is attempting to redefine the competitive space. Eaton has traditionally dominated what's called the gray space. That's the power infrastructure outside the compute rack, the breakers, the UPS systems.
And Boyd is the white space.
Boyd specializes in the white space, the thermal management and liquid cooling solutions inside the rack.
So they're essentially buying their way into the highest growth, but also maybe the highest risk part of the data center.
Correct. The ultimate goal here is to integrate these two domains. They want to create a seamless, holistic, chip-to-grid solution for AI data centers. By combining power and cooling, Eaton aims to increase its critical content per megawatt in a data center from the legacy figure of roughly $1.5 million to nearly $3 million.
Doubling their wallet share.
If they succeed, they double their wallet share, and, critically, they increase customer lock-in by selling a single integrated system rather than disparate components.
That's the theory anyway. To contextualize the pricing power this grants them, let's place Eaton's 30.3% America's margin against the global oligopoly.
Yeah, we have to look at the quadropoly. Eaton, Schneider, Siemens, and ABB Schneider Electric, which is dominant globally and highly valued for its software lock-in via AV-EVA, operates with group-adjusted EBITDA margins around 18%.
Oh.
Siemens, which is focused on factory automation, sees maybe 20% to 23% in its core digital industry segment. ABB is typically in the 17% to 18% range. Eaton's Electrical Americas is 30.3%.
The contrast is just stark.
It is, and it tells us exactly why the market assigns Eaton a premium EV to sales multiple of approximately 5.0x versus Schneider at 3.1x and Siemens at 2.0x. The market is paying top dollar for two factors: the cleaner, geographically concentrated U.S. exposure and the direct, non-diluted leverage to the reshoring and AI trends happening specifically within that protected NEMA ecosystem.
Now, we have to acknowledge the one competitor that operates with a similar AI halo valuation premium, Vertiv.
Yes, Vertiv, VRT. Vertiv is the established, formidable incumbent in data center thermal management. This is the exact space that Eaton is buying into with Boyd.
So they're going head-to-head.
Vertiv has long dominated the white space infrastructure globally. The sources indicate that the battle between a newly integrated Eaton via Boyd and Vertiv for AI data center wallet share will define the competitive dynamic of the next 5 years.
And Vertiv's valuation is even richer.
It is. Crucially, Vertiv's stock trades at an even more aggressive multiple, north of 35 times forward PE, which just demonstrates the fever pitch of the AI halo that both companies now share. If Eaton is priced for perfection, Vertiv is priced for, hyper-perfection.
Eaton's management has successfully orchestrated a narrative shift. They've transformed the company from a slow-moving GDP proxy to a perceived secular growth play.
They absolutely have.
They've moved the needle from an anemic 1% to 3% organic growth a few years ago to sustained high single digits.
That sustained momentum is crucial to justifying the premium. They delivered 8% organic growth in fiscal 2024, and they maintained that pace right through the first half of 2025. Now, Q3 2025 saw a slight overall deceleration to 7%, but the trend remains structurally strong, far outpacing typical industrial growth.
But let's not be blinded by the aggregate number. As a critical investor, you have to highlight the sharp internal divergence. Which businesses are truly driving the growth and which are acting as anchors?
The growth narrative is entirely dependent on two engines that are masking profound weakness elsewhere. Aerospace, which is driven by commercial build rates, posted impressive 13% organic growth in Q3 2025.
Okay.
And Electrical Americas grew 9%. Those two segments are pulling the entire corporate train uphill.
And anchors.
The anchors are the mobility group, as we discussed. Vehicle contracted by 9%, and strategic failure, e-mobility, contracted by a painful 20%. This concentration of growth in just two segments means the company has extremely little margin for error. If the electrical cycle were to plateau or the AI boom moderated even slightly, there is no secondary high-growth engine to provide ballast.
The experienced analyst needs to look at the quality and longevity of the backlog. You mentioned the $12 billion in Electrical Americas, but how far does management's visibility truly extend?
Management's visibility is, frankly, exceptional right now. They actively track a pipeline of announced mega projects. We're talking massive capital-intensive investments, like new semiconductor fabs driven by the CHIPS Act, electric vehicle battery plants, and LNG export terminals.
And the size of that pipeline?
It totals over $1.9 trillion,
Julian.
with a T. And that pipeline is up 33% year over year, signaling a multi-year structural investment wave in North America.
$1.9 trillion in announced projects. That's a staggering figure that gives them structural tailwind certainty for years.
It does. The $12 billion backlog provides revenue conversion visibility through 2026 and well into 2027. Furthermore, the book-to-bill ratio, which is a measure of whether new orders are outpacing current shipments, that remains robust at 1.1x.
So demand is still accelerating.
It means that demand is still accelerating faster than they can deliver product, which is a clear signal of sustained robust demand, even as some of the broader supply chain issues, like those related to transformer availability, are slowly starting to ease.
Let's deepen the discussion on the single most disruptive catalyst here, the AI power density dynamic. This is the foundational justification for that very expensive Boyd acquisition. You mentioned the shift in data center physics. Let's make that crystal clear for everyone.
The physics have fundamentally changed because of generative AI. Traditional air cooling infrastructure simply cannot handle the heat flux generated by these new 100-plus kilowatt GPU racks. We are moving from racks consuming the power of a suburban house to racks consuming the power of an entire neighborhood block.
And that heat density requires a structural migration to what?
Liquid cooling, specifically direct-to-chip or immersion cooling.
Why is this critical? Why is liquid cooling mandatory, not just a nice-to-have upgrade?
It's a thermodynamic mandate. Air simply cannot absorb heat efficiently enough at these power levels. Liquid cooling solutions, which target the source of the heat directly, are necessary to prevent GPU performance from throttling and to prevent component failure. Management estimates this critical liquid cooling subsegment will grow at a stunning 35% compound annual growth rate right through 2030.
A 35% CAGR.
Eaton, by buying Boyd, is betting $9.5 billion that they can become the dominant infrastructure provider for this inevitable liquid cooling transition.
And the Q3 2025 results suggest they're successfully capturing this initial wave, at least.
They do. The numbers are concrete evidence of traction. Data center orders increased a remarkable 70%, and sales rose 40%. This confirms Eaton is successfully positioning itself to meet the initial hypergrowth demands. The Boyd acquisition is an attempt to accelerate that content per megawatt increase from $1.5 million to $3 million, ensuring they capture both the facility power and the complex thermal management layer.
Okay, here's where the critical eye must sharpen. This is a hypergrowth segment, which implies hypergrowth risks. What are the major downside risks to this currently immaculate growth thesis?
Right. You need to focus on two primary external risks that could immediately pressure that 30x multiple.
First, what the sources call the air pocket risk.
This is an execution risk tied to the backlog conversion. Despite that robust $1.9 trillion pipeline, the sheer volume of these megaprojects has created bottlenecks. We're seeing severe shortages in skilled labor, specialized transformers, and other long-lead materials.
And the market is pricing in perfect execution.
The market is pricing in flawless, immediate revenue conversion of that $12 billion backlog. If project timelines slip, not because of a lack of demand, but because of labor or material shortages, Eaton will miss revenue targets. A miss, even if demand remains robust, will cause a violent multiple contraction because the valuation leaves absolutely no room for timing delays.
That's a key distinction. They get penalized not for a lack of orders, but for the inability of the entire ecosystem to convert them fast enough. What about the concentration risks in their customer base?
That's the second, and I would argue greater, risk, hyperscaler concentration. Eaton's most profitable growth is now heavily reliant on the massive capital expenditure budgets of a handful of customers.
We're talking Amazon, Microsoft, Google, and Meta.
The big four tech giants. Their fortunes are now intrinsically tied to the investment cycles of those four companies.
Does that give the hyperscalers leverage over Eaton's pricing?
It certainly introduces pricing vulnerability. If one of these giants decides to pivot its architectural strategy, say, shifting its cooling approach, or choosing a standardized data center design that favors a lower-cost competitor, Eaton could face immediate pressure. Furthermore, after a major investment cycle, these hyperscalers often enter a period of digestion.
Where they slow down orders.
Exactly. They slow down to utilize existing capacity. A collective pause by these four customers would translate instantly into significant order cancellations or deferrals, and that would shatter the 12–15% growth expectation the stock is currently priced for.
And we mustn't forget the self-inflicted wound here. the e-mobility failure. A segment that contracts 20% while the rest of the company is booming is more than just a mild disappointment.
It's a structural indictment. The failure of e-mobility means the Electrical Americas and aerospace segments must deliver without interruption. The company has zero internal diversifiers. This failure forces the sophisticated investor to question management's execution capability outside of their core NEMA comfort zone, which in turn makes the massive, aggressive leap into the thermal management white space with Boyd even riskier.
Let's move to capital allocation, which, for the experienced investor, is the ultimate measure of management discipline. And it's fair to say that prior to this recent massive bet, Eaton had a highly disciplined and successful track record.
They were masterful allocators. Their history shows a very disciplined purification of the portfolio. They successfully shed low-margin, cyclical assets like the hydraulics business to Danfoss for $3.3 billion at a very attractive 13.2 times EBITDA.
And the lighting business.
And later divested the lighting business. These were master strokes that fundamentally improved the quality of the overall margin profile.
Their M&A was also traditionally accretive and focused on bolt-ons.
Yes, exactly. The 2021 acquisition of Tripp Lite for $1.65 billion was highly successful. It immediately expanded their distributed IT footprint, just as the edge computing trend was taking off. It established a strong precedent for buying wisely. They also committed wisely to organic growth, investing a significant $1.5 billion in capital expenditures to expand manufacturing capacity, particularly for electrical components, which generates very high internal ROIC.
That prior discipline makes the critical pivot, the Boyd thermal acquisition, stand out in such high contrast. This deal is really the centerpiece of the bad price thesis.
This is the definitive strategic move that made the most disciplined investors step back. Eaton agreed to acquire Boyd Thermal for a massive $9.5 billion. This is not a bolt-on. This is a strategic leap. And the price tag suggests a departure from disciplined value creation to a growth-at-any-price mentality.
Let's get granular on that valuation critique. $9.5 billion for an industrial asset.
The valuation is staggering. We are talking about paying 22.5 times estimated 2026 EBITDA.
22.5 times.
To put that into perspective, that is the kind of multiple usually reserved for high-flying, asset-light SaaS companies with 90% gross margins, not for an industrial provider of pipes, pumps, and thermal management systems. That price explicitly prices in not just the continuation of the AI data center boom, but 5 to 10 years of exponential growth with zero competitive pressure. It suggests management was desperate to buy this specific growth story.
And this deal introduces immense and concentrated execution risk, made even worse by the timing.
Significant integration risk. We're talking about combining 5,000 new employees with a completely different culture, massive IT integration, and critically technical risk. The technology in liquid cooling is evolving so rapidly. If the industry pivots away from Boyd's current IP, say, towards a different immersion fluid or a different architectural approach, Eaton will have grossly overpaid for a technology peak.
So it's a bet-the-company move.
This deal is rightly classified as a high-stakes bet-the-company move, precisely coinciding with a major CEO transition.
Let's talk about that transition and the questionable use of shareholder capital surrounding it.
We have to scrutinize shareholder returns against this backdrop of aggressive M&A. Despite the $9.5 billion outlay for Boyd, which is largely debt-fueled, Eaton still plans to repurchase $2.0 billion to $2.4 billion in shares in 2025. This raises serious questions about capital allocation sensitivity.
Repurchasing shares at 30 times earnings and at all-time highs, doesn't that suggest management is indifferent to valuation?
It certainly does. A disciplined allocator would drastically reduce buybacks to aggressively focus on deleveraging after taking on such a massive debt load. Buying shares back at a peak multiple suggests one of two things. Either management genuinely believes the stock is cheap, which is completely contradicted by the 22.5x EBITDA they just paid for Boyd, or that they are prioritizing EPS accretion over balance sheet prudence. This lack of valuation discipline just compounds the risk profile.
And this massive financial bet is happening at a moment of significant leadership transition, which adds another layer of execution risk we have to analyze. Let's look at the signals coming directly from the C-suite.
The leadership transition introduces heightened risk, no question. The outgoing CEO, Craig Arnold, is retiring, with Paulo Ruiz stepping into the CEO role in June 2025. This means the new CEO's entire tenure and his credibility with the investment community will be immediately and irrevocably tied to the flawless integration and success of this multi-billion-dollar Boyd deal.
He needs this deal to be perfect.
He absolutely does, which potentially creates management incentive to overpromise and underdeliver on the synergies and the growth.
And what about the insider trading activity? That's often a soft signal the discerning analyst watches, especially during a transition like this.
The data is. It's notable. Craig Arnold, the outgoing CEO, sold over $71 million in stock over the last 2 years,
71 million.
including significant large-scale sales in May 2025, right around the time the high-valuation Boyd acquisition was being finalized. Now, while executives routinely diversify, the sheer magnitude and timing of the selling at all-time peak valuations, and just as the company takes on its largest debt-fueled risk, serves as a soft but undeniable signal. It suggests insiders themselves, despite their public confidence, do not view the stock as undervalued at these current highly elevated levels.
Before we deliver the final verdict on valuation, let's confirm the underlying financial scaffolding is sound. What does the quality of earnings check reveal?
The financial health is strong. The strategic pivot has resulted in structurally expanding profitability. Segment operating margin hit a record 25.0% in Q3 2025, which confirms significant pricing power and operational leverage. More critically, cash flow conversion is a hallmark of high earnings quality. The profits are real.
How does that conversion look, especially against net income?
Eaton typically converts over 100% of net income into free cash flow, FCF. They generated $3.5 billion in FCF in 2024, and they project around $3.9 billion for 2025.
Right.
So the cash generation capability is stellar. One small note for vigilance. The company does rely heavily on non-GAAP adjusted earnings.
Right.
So the critical investor must closely scrutinize the gap between GAAP and non-GAAP EPS. It was $2.59 versus $3.07 in Q3 2025 to ensure non-recurring charges aren't systematically inflating those headline figures.
And despite that phenomenal FCF generation, you highlight what is maybe the most critical point of the bad price thesis, the extremely tight FCF yield.
This is where the rubber meets the road. Despite generating nearly $4 billion in free cash flow, the stock's market capitalization has ballooned so quickly that the free cash flow yield has compressed to a very tight 2.2% to 2.6%. The implication here is profound for an experienced investor.
What's the implication?
With the current risk-free rate, the rate on U.S. Treasuries hovering around 4.5%, the stock offers virtually no risk premium based on its current cash flows.
Wait, let me just unpack that for a second. We're essentially saying that an investor buying Eaton today is accepting a lower yield, 2.2 to 2.6%, for holding a cyclical industrial asset than they would get holding risk-free U.S. government bonds at 4.5%.
That is the sober, quantitative truth of the situation. Any value creation you see from this point forward must be entirely predicated on future, perfect, high-growth assumptions that may or may not materialize. You are paying today for cash flows that are 5 to 7 years out and receiving zero compensation for the inherent risks associated with an industrial conglomerate risks, like cyclical downturns or integration failure.
We must also consider the immediate impact of the Boyd deal on the balance sheet.
The $9.5 billion debt-fueled acquisition is a major factor. It will push Eaton's net leverage ratios temporarily toward or potentially above 3.0x. Now, management has a good history of rapid deleveraging, but this temporary increase in debt reduces crucial financial flexibility. It also increases the company's sensitivity to interest expense, especially in a higher-for-longer rate environment, which could potentially pressure future earnings until that debt is paid down.
So let's finalize the numbers that define the bad price thesis. What is the absolute and relative valuation context?
Eaton is priced at a multiple never before sustained by the company. Current forward PE estimates are between 29 times and 31 times, based on their 2025 EPS guidance. Historically, Eaton traded as a cyclical industrial in the 15x to 18x range.
So a massive re-rating.
A massive near twofold multiple re-rating. They are effectively capitalizing the business as a technology or software growth stock, not as a diversified industrial.
And compared to its core industrial rivals.
The premium is astronomical. Eaton, at 30x PE, trades far, far above diversified, high-quality peers like Schneider Electric, which is around 21x PE, or Siemens at around 16x PE. Eaton is fundamentally priced closer to the pure-play, high-beta AI infrastructure stock, Vertiv, which trades over 35x PE. The market is unequivocally applying an AI halo premium to Eaton, demanding growth rates far beyond its historical norms.
So for you, the experienced investor, what exact compound annual growth rate must Eaton deliver to justify a 30x multiple?
The math is unforgiving. To justify this valuation, Eaton has to deliver compound earnings growth of 12% to 15% annually for the next 5 to 7 years. This is an immense ask for a company of this size and asset profile. It requires the data center boom to continue without any interruption, without any cyclical deferrals, and with absolute flawless execution of the multi-billion-dollar Boyd integration.
And this brings us back to what the sources are calling the perfect perfection risk.
That is the single most important risk. The risk is not that Eaton fails as a business. It's too high quality for that. The primary risk is valuation compression. The stock is priced for an operational outcome that is mathematically perfect. Any slight operational miss, any cyclical softening, or any indication that the Boyd integration is facing indigestion will lead to a violent multiple contraction, potentially pushing the stock back toward its historical 20x range. That risk-reward profile is dramatically skewed to the downside today.
Okay, let's synthesize this very complex picture. On one hand, Eaton has successfully transformed into a high-quality compounder. It has a genuinely defensible moat, particularly in its Electrical Americas NEMA business, and real structural secular tailwinds thanks to AI, reshoring, and electrification.
On the other hand, the investment case is fundamentally marred by a non-existent margin of safety. That's evidenced by the tight FCF yield versus the risk-free rate, and a capital allocation approach that has become aggressively expensive, epitomized by the $9.5 billion Boyd acquisition and an unsustainable 22.5x EBITDA multiple.
So, what is the final critical recommendation for the disciplined investor looking past all the headline excitement?
The recommendation has to be hold neutral. We avoid chasing the stock at 30 times earnings. The risk-reward profile is fundamentally asymmetric, and it is skewed to the downside because the market has already fully priced in a perfect operational outcome well into the future.
If the opportunity is currently poor, what specific high IQ monitoring points should you, the analyst, be watching for? What would signal an attractive entry point or a definitive red flag confirming the bearish case?
We have three key monitoring points. First, monitor for a cyclical correction. Wait for a broader market pullback or an industrial softening that brings that PE multiple down to the more rational 20x to 22x range. That is the price where the quality of the underlying asset provides an adequate margin of safety.
Second, the execution of the biggest financial bet the company has ever made.
You must track the Boyd thermal integration like a hawk. Monitor for any signs of indigestion, missed synergy targets, unexpected integration costs, cultural clashes, or technological issues in the thermal solutions. Given the excessive price they paid, any integration stumble is a major red flag that confirms the growth at any price strategy was flawed.
And finally, the purification of the portfolio.
The third point is to watch for a strategic catalyst. We need a definitive announcement regarding the divestiture of the shrinking low-return vehicle and e-mobility segments. That would instantly purify the portfolio, it would raise consolidated margins, and it would unlock latent value justifying a slightly higher, but still rational, multiple on the remaining electrical and aerospace core. That move would signal that management is prioritizing quality over empire.
That sets a very clear diligence path forward for the sophisticated analyst. Let's end with a final provocative thought that builds on this tension between the internal structure and the external valuation. Eaton's financial dominance is built on its NEMA-protected geographic moat. Management has historically resisted shedding the mobility business, but the financial metrics are screaming for portfolio purification. Given this tension, will the structural flaw of the mobility segment eventually force a strategic divestiture that unlocks immense shareholder value and purifies the compounder narrative? Or will the highly aggressive, debt-fueled M&A approach embodied by the vastly overpriced Boyd deal define the tenure of the new CEO, Paulo Ruiz, and ultimately prove to be an overreach that leaves long-term shareholders holding the bag at peak valuation? It's a fascinating company to watch, but one best watched from the sidelines for now, waiting for the price to reflect reality.